Price patterns are probably the most widely used of the tools in the technical arsenal. Most are highly effective, but as with all techniques, they do fail from time to time. Remember, in markets we're dealing with crowd psychology, and crowds, just like individuals, can and do change their minds. As we proceed, you'll be able to recognize how price patterns in many ways incorporate the basic building blocks we covered in the first session.
These key building blocks are peak and trough analysis, support and resistance, trend lines and volume. It's possible for price trends to reverse on a dime, as an uptrend is quickly reversed into a downtrend, just like this. However, this type of reversal is very much the exception and not the rule, as this replicates a highly emotional market that changes without warning. A more likely scenario is this kind of trajectory, in which the price rallies, experiences a trading range, and then declines. Then the price is likely to undergo some more ranging action, which forms part of the foundation for a renewed advance, and so forth. It's therefore more normal for rising and falling trends to be separated by a transitional period or trading range, where buyers and sellers are equally matched. An oil tanker takes a long time to slow down and then go into reverse. But the same thing is normally true of financial markets. Generally speaking, the longer the trend, the more time spent in the reversal or the turnaround process. And of course, the bigger the ensuing trend is likely to be. This transitional or horizontal phase has great significance because it marks the demarcation between a rising and falling trend, or vice versa. If prices have been advancing, the enthusiasm of buyers has outweighed the pessimism of sellers up to this point, as buyers have optimistically bid prices higher. During the transition phase, the battle between optimism and pessimism becomes more or less even, until finally, for some reason or another, it's tipped in a new direction, as the relative weight of selling pushes the trend of prices down. It's the breaking to the post-transitional new low ground that alerts the trader to the fact that a reversal in trend has taken place. In other words, when prices fall below these lows, which represent support, it means that sellers have won the battle. At the termination of a bear trend, the reverse process occurs, where overhead resistance in the form of these highs is finally overcome as the buyers take control. Over the years, technicians have noted that such ranging action at both tops and bottoms has taken the form of clearly definable price patterns or price formations, and we call these classic price patterns. This diagram shows the price action at the end of a long rising trend. At this point, it looks like a pretty normal digestion of previous gains. One thing we should expect is that the high and low indicated by the red and green arrows, being previous pivot points, could turn out to be resistance and support points. As I uncover some more of the action, you can see that this was so. Now it's possible to draw two parallel lines at the upper and lower boundaries of this trading range. They represent support for the lower one and resistance for the higher one. The temporary reversals at the highs may occur because buyers refuse to pay up for security. The higher price attracts more sellers, or because of a combination of both reasons. The lows may develop because buyers think that prices are bargain at these levels, and sellers just refuse to give their securities away at what they consider to be fire sale prices. As we progress, you can see that resistance continues to develop at the upper line and support at the lower line. Then we see another advance that once again contains the enthusiasm of buyers, to the extent that we now have some clear-cut demarcation lines. Eventually one side will win out, and in this case it's the sellers, who are now so motivated that they push the price below the support level or the lower trend line. This is the sell signal, which indicates that the trend is now a negative one so far as this particular piece of evidence is concerned. This trading range, separating rising and falling price trends, is a pattern known as a rectangle. Since the breakout from the pattern signal a reversal in trend, it's called a reversal pattern. The actual signal was given when the price breaks decisively through the lower horizontal trend line. This is also the point where the series of rising peaks and troughs was reversed, because the breakout took the price below its previous low. Reversal patterns at market tops are known as distribution. This is where the security in question is said to be distributed from strong, informed participants to weak, uninformed ones. The underlying psychology is that during the formation of the rectangle, the news is good, and uninformed market participants, hearing it for the first time, are encouraged to buy. Forecasts at this time are also quite rosy, so little risk is perceived from the long side. Every transaction has to have two parties, a buyer and a seller. For their part, the sellers or distributors have a different idea. They've been carefully buying on the way up in anticipation of the good news. Now that it's materializing, it's time to sell. And who better to sell to than those uninformed participants who are hearing the good news for the first time? This kind of activity has given rise to the well-known expression, buy on the rumor and sell on the fact. Price patterns that develop at market bottoms are called accumulation formations, where the security passes from weak, uninformed participants to strong, informed ones. In this instance, the underlying psychology is reversed, where weak holders, having seen the price of their security move lower, decide to sell when the bad news and forecasts of more to come start to filter to the investment community. By the same token, potential buyers previously held off because they wanted to get the bad news and presumably lower prices out of the way. The emergence of discouraging reports and so forth is therefore one of the signals these so-called strong buyers had been waiting for. Another might be a sign that things are going to improve down the road. But this process is called accumulation because informed buyers are said to be accumulating in anticipation of better times ahead. These are said to be strong buyers because they're not easily put off by discouraging news. Their focus is on the future, and only when they see signs of poorer than expected developments down the road are they likely to liquidate. It's also important to understand that a reversal pattern must have something to reverse. In other words, all reversal patterns must be preceded by a prior trend that develops in the opposite direction to the reversal signal. Tops must be preceded by uptrends and bottoms by downtrends. We've already seen a rectangle develop at a market peak. As you may have already guessed, they also develop at market bottoms. Here's an example as the price comes down, experiences a trading range, and then breaks to the upside. Once again, the breakout signifies that the series of declining peaks and troughs has now reversed. We can also spot rectangles that form in the middle of a trend. In this example, this trading range is completed with a victory for the buyers as the price pushes through the upper line of the range and a reversal does not develop. That's because the breakout reaffirms the underlying trend. In this case, the corrective phase associated with the formation of the rectangle temporarily interrupts the bull market and it becomes a consolidation formation. Such formations are also referred to as continuation patterns. During the period in which the pattern is being formed, there is no way of knowing in advance which way the price will ultimately break. Consequently, it should always be assumed that the prevailing trend is in existence until it's proved to have been reversed. If we are faithfully applying the weight of the evidence approach, it may be possible to anticipate a reversal, but only if the other indicators are pointing in that direction. The pattern itself, though, can never be categorized as a reversal type until one is actually signaled. A continuation or consolidation rectangle and a downtrend is shown in this chart. Note that a rally develops after the breakout. This is known as a retracement move and is a normal type of phenomenon. Since the lower area of the rectangle was support before the break, it now reverses its role to resistance and is a natural place to expect the rally to halt. If it doesn't, then we're faced with a problem, and I'll get to that later. This chart shows a continuation rectangle for the copper price. Note that after the breakout, you are left in doubt for a couple of days as the price experiences a sideways digestion of losses. This is a normal phenomenon, but if the breakout is valid, then you should expect to see the price resume its downtrend. The principles of price pattern construction and interpretation can be applied to any time frame, from 1-minute bars all the way through to monthly or even annual charts. However, the significance of a price formation for a specific time frame is a direct function of its size and depth. We've already established that a rectangle whose boundaries in the form of trend lines have been touched many times is more significant than one that's only been touched twice. We can extend this idea, though, by saying that the longer a pattern takes to complete, the greater the number of fluctuations within it, and the deeper its trading range, the more substantial the following move is likely to be. Let's consider these three factors in turn. The longer the time frame, the more significant the pattern. A pattern that shows up on a monthly chart is likely to be far more significant than one on an intraday chart, and so forth. Let's compare an accumulation pattern at a price low with the construction of a building. It's just as important to build a strong base from which prices can rise as it is to build a large, strong, deep foundation upon which to construct a skyscraper. In the case of a security price, the foundation is an accumulation pattern that represents an area of indecisive combat between buyers and sellers. During an accumulation phase, more sophisticated investors and professionals are positioning or accumulating the security in anticipation of improved conditions 6 to 9 months ahead. As mentioned earlier, ownership is being transferred from weak, uninformed traders or investors into strong, knowledgeable hands. Consequently, the longer the pattern takes to complete, and the greater the level of activity within it, the more significant the accumulation process, and therefore the stronger the technical foundation. The reverse is true at market tops, where a substantial amount of distribution inevitably results in a protracted period of price erosion. Look at this trading range that existed for the CRB composite between 1957 and 1972. It was a rectangle, and the breakout was followed by a multi-year advance. No way of being able to forecast the character of this move, merely that this 15-year base was likely to support a major rally. Later on, we see a consolidation rectangle. Its breakout was also followed by a strong advance. The greater the number of fluctuations within a pattern, the greater the significance. When the price action has been in a stalemate for a long time and investors and traders have become used to buying at one price and selling at another, a move beyond either limit represents a fundamental change, which has great psychological significance. In addition, each fluctuation means another battle between buyers and sellers. When one side or the other eventually wins out, the other side will be exhausted, and so a more significant trend is likely to follow. The depth of a formation also determines its significance. Consider a trench war analogy. If the opposing trenches are very close together, say within 100 yards, this means that the victorious assault, when it comes, will be less significant than if they are separated by several miles. In that case, the battles would have been much more intense and the victory much greater. The same is true in the financial markets. The breaching of a wide trading range generally has far greater psychological significance than of a narrow one. Psychology, as expressed in market prices, tends to move in proportion. The greater the swing within the pattern, the greater the subsequent move is likely to be. If you get wide price swings during the formation of the pattern, you're also likely to get wide swings after it's been completed. This brings